Welcome to my channel. I'm Dr. Romano. In today's video, we are going to be discussing why hedge fund managers make so much money. And I'm going to walk you through as to why that is. Let's discuss first what a hedge fund manager is. A hedge fund manager is a trader that trades on a particular market. They refer to the company as a hedge fund as if they are hedging something, but that is a wrong term to use. They are simply an investment company, and in the 60s and 70s, that term hedging was actually coiled as to what they're doing, because back then they were hedging positions. But today, hedge funds are associated with many types of strategies and types of market that they trade in. Now, the reason why hedge funds make so much money is because that trader had a track record, right? And once you have a 5-year track record of trading capital, then you could start to get other people's capital and start growing that portfolio to bigger and bigger and bigger. And then at a certain point, you can actually establish your own hedge fund. And by doing so, you create your LLCs in Delaware and your LP. So one LLC is for the management company, another LLC is for the actual brand, so to speak. And then finally the LP is where the money actually is in the actual fund itself, etc. So it could be Romano Wealth Management LLC, that is the actual brand. Romano Funds of Funds American Equities would be the LP, the actual fund. And then you have another company, which is Romano Capital Management, and that particular LLC is the LLC that will collect the fees from the client. Hedge funds do charge fees for their services, and so 1 or 2% of the total capital invested will basically cover the administrator, the hedge fund accountant, as well as the audit company. Because you have to remember, hedge funds have to be audited by an outside company every year to check their records and stuff like that. The actual administrator handles and facilitates all of that work to make sure everything's done correctly. And then we have the hedge fund accountant, which is also separate. And from there, you have that person basically charging the fees, writing out the checks, etc. The hedge fund manager, all that person actually does is trade capital and manage the portfolio. They could also be the one to raise capital in the beginning. At a certain point, you could hire people to raise capital, to do the marketing, to do any other types of things that hedge funds do. We're not talking about the big top 10 hedge funds. Those are gigantic companies that hire traders to trade for them. And so they're simply copying what the investment bank has done. And that's why their returns are so watered down. Before we continue the video, please remember to do thumbs up. It's right there. Just click the button to say thank you. Thank you so much. Whereas the smaller hedge fund manager, their returns are phenomenal. They're amazing. And the fact is the reason why they do so well is when you give the authority to that person, they will always flourish. And so when you train a child to ride a bike, when you compliment that child, when you allow that child to actually ride the bike without you holding the child, you're giving that child self-confidence and authority. And they will take that authority and they will grow and flourish. And that's why hedge fund managers have been doing so well over the past 25 years, because all those people in the beginning of the 1990s and 80s, they were laid off because of the mergers and acquisitions of the investment banks that became the investment banks. And whenever you have government regulation change things, it fixes one problem, but it creates another problem. And it created a huge problem that we see today in investment banks. They're too big and they keep failing. And this is just another reason why hedge funds are doing so well. And so the reason behind as to why a hedge fund manager makes so much money, it's not that they're doing something illegal or something that's hidden from society. The fact is that they're simply doing the same thing a investment bank does. At the investment bank, you'll have trading floors, trading groups, and those groups will trade the company's capital. So the investment bank is doing the same thing that a hedge fund manager does, but the investment bank will not share most of the returns with their clients. It's a different type of restrictions based on the SEC. It's a different type of legal requirements for the investment banks as opposed to the hedge funds. Yes, hedge funds have more freedom, but that's what you want. You want the hedge fund manager to have that freedom to change their strategy, to change their risk approach and with everything they do. And because they have so much freedom as the owner of the company, the hedge fund, of course, is going to continue to tweak their strategy to do better. But at the investment bank, the trader, they're not allowed to do that because it's such a big company. And when you have 5 levels of management on top of you, things get lost. And that's why the investment bank returns is so watered down as opposed to the hedge fund returns. The hedge fund returns, when it's a smaller hedge fund, under $1 billion, they do so much better because the owner of the company is there trading. You also have business partners, possibly, if the owner of the company didn't have that type of capital to actually start. It just means a lot of different changes that can happen very quickly for the better. And this is why 1 level of management is better than 5 levels of management. And so once the actual hedge fund makes a profit, they will charge the client a fee for that. That could be 20% and above. It just depends the fund. But typically it's 20%. The hedge fund does 20%, that's 20 million. The hedge fund will take 20% of that 20 million. And so that is around $4 million that will go to the hedge fund manager. But also, the hedge fund manager charged a fee for the assets under management. So if it's $100 million, they charge 1%, that's $1 million. And because it's such a small company, you're not going to have, let's say, a whole team of marketing, of investment management, of analysts, etc. Typically, the hedge fund manager is doing all of that by themselves, and they could also have business partners that specialize in that, and they come together as a group to kind of make the company look better with someone who has risk management experience, someone who was a director of portfolio management at an investment bank, someone who has quantitative skills such as programming, etc. So you will get a group of people that will work together. But technically, and this is my reasoning, the trader themselves should be able to manage their capital, to be able to manage their risk and their strategy. And if they're capable of doing that from the beginning, then they will succeed throughout their career. But if they're not capable of that, if they're not capable of managing their risk from the beginning, what you're going to have is up and down swings in their returns, such as Richard Dennis. Richard Dennis could turn the portfolio into billions, but he couldn't manage the risk appropriately until he came in contact with Bill Eckhart. And Bill Eckhart had a quantitative background in risk management. I think he had a PhD in math or something like that. And so he was able to help Richard tweak the risk management of that fund. However, you'll see at the end of the time that the fund did blow up. So again, if the hedge fund manager can't manage risk from the beginning, the outcome in the future is just going to be really bad. And this is what I've seen in hedge fund returns from when they start out with 2 years, 3 years experience, meaning that they actually created a hedge fund and they have AUM under management. It may not be 20, 30 million, but it's still 10 million, 5 million is enough to see how well they'll do in the markets. And so this is a reason why hedge fund managers do so well. They have the freedom. And from the beginning, they should know how to manage their risk. And for those managers that do know how to do that by themselves, meaning they know how to do the marketing of the fund, they know how to talk to the clients, they have charisma to raise capital. When they sit down with the clients will believe them and trust them. And it's literally a 2-second yes or no if that client will give money or not. And so that's the reasoning behind as to why hedge fund managers do so much and they are so successful compared to the investment bank. And so that is my reasoning why hedge funds do so well, and this is why the community is focusing on hedge funds now, not so much investment banks. So billionaires, let's say Warren Buffett or whoever it may be, they're more likely to invest in hedge funds than the investment bank. And when this becomes more prominent, investors that have less capital and they see the performance and they understand hedge funds better, it's only a matter of time before the investment bank industry goes away and dwindles in size. Because even endowments don't need to go to investment banks anymore. They could go directly to the hedge fund community. But there's a problem. The investors that invest in hedge funds, they're not always aware at which hedge fund to invest in. And this is why you need a specialist. So now they've been trusting the investment banks with the capital, which hedge fund to invest in, but still they're not able to maximize profits. And so this is why the funds of funds industry, as of today, has been growing enormously because the funds of funds manager, such as myself, is more prepared and more educated and more qualified to select and deselect a hedge fund for that particular portfolio. It's not that the people at the investment bank don't know anything. It simply is that they have to follow the requirements of the company. Again, 5 levels of management is terrible. And this is why the smaller funds of funds are now going to be flourishing once again with this new industry that has come about. In the past, funds of funds were unpopular because there are 2 levels of management. You have the management fees from the hedge fund and the management fees from the funds of funds. But if you could get a funds of funds manager that is able to maximize returns and limit risk, then of course that's not a problem. And so I want to thank you so much for watching my video. Please remember to subscribe to my channel and please do thumbs up to say thank you, Anthony. It's right there. All you have to do is press it. It doesn't bite. And that will tell me that you appreciate these videos. Thank you so much.